When Petronas announced a 5,000 job cut on top of a hiring freeze until the end of 2026, that immediately caught my attention. This is not just another oil and gas company, it's a behemoth that contributes more than 20% of Malaysia's total revenue in 2024. And along with it, funding for our schools, hospitals, roads, public services, and even a significant portion of our annual EPF dividends. Basically, the very foundation that the Malaysian economy is built upon. And when I dive deeper and analyze and question their financials, strong cash flow from operations, and a very healthy profit after tax, albeit declining, which is totally normal due to the pandemic rebound, and also a very low debt to cash ratio of just under 20%, which means they're basically not struggling to keep up. So that leaves me with a bigger question. Why would a multi-billion-dollar company with such healthy financials suddenly announce such a huge cost-cutting measure? Are there underlying problems that we as everyday Malaysians aren't being aware about? You see, to answer that question, we need to take a step back and look at their business model so that you can understand what their exposures are. Petronas is basically a giant group with dozens of subsidiaries and partners, from Petronas Chemicals to Petronas Gas, both their Bursa-listed entities, to massive refinery and petrochemical projects locally and internationally. In fact, spanning across over 100 countries. And if you remember this illustration, Petronas basically makes most of their money from exploring and pumping oil and gas to transporting, trading, refining and selling it as a fuel, chemicals and even plastics. This means they are involved in every part of the oil and gas chain at a global level. And precisely because of that, they are exposed to oil price volatility and even geopolitical tensions. And this is where supply and demand comes into play. You see, for the longest time, China has been the largest oil importer in the world, but things began shifting in 2023 and 2024 when they finally experienced a close to 2% decline in their oil imports, their first annual decline in 2 decades if you put COVID aside. And one of the major reasons for this is no thanks to the trade war, which pushed China to reduce its reliance on oil and petrol cars and push for EVs instead. And they introduced the 5-year interest-free car loans, as well as launching a trading scheme in April 2024 as part of an economic stimulus. People could get 20,000 Ringgit or about 2.7k US dollar for trading in an old car for a new EV, and it worked like a wonder. That year alone, almost 4 million people signed up for the EV incentive. That's about 0.3% of China's population. And as a result, EVs, including battery EVs and plug-in hybrids, grew from 5.8% market share in 2020 to 47.2% in 2024 in China. That's significant because the more EVs they buy, the more it chips away at future oil demand. And on top of that, many countries are also pushing towards net zero emissions by 2050, aiming to limit global warming effects. So it's pretty clear that green energy is starting to gain traction, and that's exactly how it affects Petronas. Falling oil demand while supply stays the same means lower oil prices. And to add salt to their wound, the weakening of the US dollar also negatively impacted Petronas' revenue. You see, Malaysia's Q1 2025 oil and gas export revenue stood at 46 billion ringgit, while imports in the sector amounted to 36 billion ringgit, which means Malaysia is still a net exporter in the oil and gas industry. So let's say if today US dollar against ringgit is 4.2 and Brent crude oil is at $80 per barrel, just for assumption, assuming Petronas exports 1 million barrels out, it will be 336 million ringgit revenue. But when US dollar strengthens at 4 ringgit 60 cent, assuming all the other conditions remain the same, the revenue will be 368 million ringgit instead. That also means Petronas' revenue and US dollar are positively correlated. In other words, the stronger US dollar is, the better Petronas' ringgit revenue will be. And add to this the roller coaster of oil prices like OPEC Plus decisions on production, geopolitical tension at the Strait of Hormuz, and talks of potential ceasefires. This could all bring more oil into the market and push prices further down. And for oil producers like Petronas, budget forecasts can change overnight and they need to stay on top of it. So when Petronas announces layoffs like this one, it's not necessarily because it's failing. And of course, no one likes hearing about job cuts, me neither, but sometimes tough decisions have to be made when the only certainty in the world is change. You see, every business in this world has two sides: revenue centers, which make money, and cost centers, which don't directly bring in revenue but keep everything running, like engineers, HR, finance, or IT department. And this portion needs to be managed efficiently, because if left unchecked, their costs can grow significantly faster than revenue, thereby erasing profits, especially in volatile industries like the oil and gas sector. And long story short, it's easier to project costs, but the same can't be said for revenue. And FYI, Petronas cost centers make up about 28 to 30% of Petronas' total workforce, higher than the industry average of 18 to 25%. And since employment retention rates in oil and gas companies are generally high, that means they are less likely to release employees as compared to other sectors. As you can see, their last major layoff was almost 10 years ago in 2016. So as a result, the gradual increase in employment to handle short-term market requirements over time ultimately ends up in a bloated and inflated workforce. And if you remember, after the pandemic, the oil and gas sector bounced back fast when consumer demand picked up. Projects that were paused suddenly got resumed, and companies like Petronas hired rapidly to catch up. All of this created temporary overcapacity, especially among project-based contract workers. But now, with all the problems happening all around the world, Petronas CEO reminded that their break-even price sits around $50 per barrel. Basically, anything below that means they will be loss-making. And with Brent crude hovering around $70 as of the recording of this video, the cushion isn't as big as it was when oil was around $80 to $90 per barrel, hence the margin contraction, hence the cost control measure. And if you take a step back and look at it from another angle, global players in the same industry like Shell, BP, and ExxonMobil are all doing the same. Think about it, maybe this is not all about cutting costs after all. It is a full-on industry shift that is very much needed to adapt to the new world. Shell, for example, apart from cost cutting, the main reason for job cuts is to pivot away from fossil fuels and grow its LNG business, which is considered greener and more profitable. And layoffs are also happening outside of this industry as well. TikTok Malaysia just laid off workers last year to shift towards the use of AI. And Meta, after their massive layoff in late 2022, which Mark Zuckerberg called it as their year of efficiency, their stock price shot up over 200% in the subsequent years. So if it's not obvious already, layoffs are normal for corporations to improve their business productivity. And from my research, Petronas is strategically reallocating their resources into other investments and also expansions to diversify their revenue streams. From their 2025 to 2027 outlook, Petronas is reducing their upstream activities like drilling new wells or building new platforms, which are mostly capex heavy, labor intensive, and revenue are not guaranteed as well. So instead of that, they are focusing on their existing projects and downstream activities that will bring more near-term returns to their shareholders instead. For example, their very recent LNG project in Canada will allow them to diversify their fuel source, as well as the partnership with Italy and Japan to develop a biorefinery in Malaysia that will turn raw resources into sustainable fuel, allowing them to expand their biofuel business verticals beyond just trading. And that's just one of their many revenue diversification plays. And beyond fuel, they are also investing heavily into Gentari, their clean energy arm that focuses on renewables like solar and wind, hydrogen projects, and other green solutions, with an ambitious target of achieving 8 gigawatts capacity. And while I know it's still a small part of their energy mix today, it does show that they are diversifying outside of their comfort zone as well. Now, imagine if Petronas is not cutting where they must and investing where it counts. On top of their ongoing discussions with oil-producing states, they might not be well positioned as well as stay competitive internationally amidst the global uncertainties, and that will have repercussions towards the broader Malaysian economy. And here's something interesting that I found. Back in 2016, after Petronas laid off 1,000 staff, they actually started contributing more and more to our national revenue each year. And coincidentally, our EPF dividend increased significantly in the 2 subsequent years. And I know I might be oversimplifying things, but that's just my personal observation. What do you think? Let me know in the comments down below. Thanks for watching.